Okay, let's not delay any longer. My name is Justin Kribs with InsMed. I will be your volunteer presenter today for Financial Beginnings presentation on risk and risk management. I'm joined by Joanne, who is the area coordinator for California. We'll be able to take questions. Right now we have a lot of people muted. We should be able to allow people to unmute themselves later on. You can also ask questions through the chat feature. If you see me doing this every now and then, that's only because I have multiple screens going on right now, and I have kind of my control panel on this side over here. So hopefully I should be making virtual eye contact with you during the entire presentation. So today, risk management, protecting yourself. Risk is something that we all deal with, and I don't know what's going on there. There seems to be some sort of line drawn. So there's our first technical glitch. See if we can undo anything. Ah, wonderful. Good. So that worked. Now I know what that does. All right, so back to it, risk. We all deal with risk. Risk is inherent in life. Risk is, as defined, the possibility of loss or injury, and also you have your perils, which is your cause of loss or injury. So you have different perils, can be things like rock climbing, surfing, working with highly infectious patients, what we have going on right now with COVID-19 and how different insurance companies are treating practitioners a little bit differently now. You have health issues, driving, cliff jumping, all these different things would be considered a peril, which can create risk. And I think we have an extra mic that's going on. Perfect. All right, so that is it. You have risk, loss, peril, the cause of the loss. When you look at risk management, what they're talking about is your ability to, purchase different insurance products or change behaviors in such a way that will minimize your exposure to risk. So that's what that is. And when you're looking at a financial plan, when you're looking at everything you have going on in life, you have to take a look at, okay, what are my various risk exposures? And as you go along through life, your risk exposures change. For instance, when you're young and you're just starting out, you don't have an exposure. There's no need for like life insurance. Of course, when you talk insurance, everyone has a very they have a very opinionated thought process when it comes down to it. But really, you look at it, okay, what is the financial impact of the family for loss? So you think about, okay, what is the need that I'm filling? As you go along through life, your needs change, your risks change. Will you need life insurance? Do you need to take on disability insurance? Do you no longer have the need for disability insurance? Do you need to change your auto insurance coverage? Do you have need for umbrella insurance? You look at your exposures, you look at everything that's out there that can affect you. And you have to take stock of and kind of go, okay, well, if this happens, what is my loss? Should I purchase a policy to cover that loss? Or is it a risk that you're okay with the loss should it happen? It's kind of like when people say, okay, I don't need comprehensive coverage on my car. If my car gets totaled, fine, I don't need that. However, I'm more concerned with the loss of somebody else's vehicle should I create or cause an accident. So there's always risks, there's a loss. Now, there are some things that we are always going to be subject to that, there's not a lot of options for us to purchase insurance to protect us. And one of those things that I like to hit on a lot, especially when I was talking to medical students when I was at OHSU, and I'll talk to residents about this quite often as well, are things like white collar crime. And these are risk exposures that we all have. You don't get rid of this. I mean, you think about everything you hear in the news about, people being swindled out of their savings, people who the people who prey on the elderly because of possible cognitive impairments. You think about these types of crimes, and there's always exposure to it. And one thing I like talking to people about, especially at the beginning of a career or even midway through your career, is about these topics. And when you think white collar crime, you're thinking financial in nature, things that where they're trying to take advantage of information that they have skimmed from you, or some way of taking advantage of your circumstances. It's nothing such as, a theft from a burglary. It's not something like a car theft. It's something, in my opinion, a lot more personal. It's that invasion. It's that taking of your identity. And some big financial crimes, or that happen to a lot of people, a lot of white collar crimes, are in the financial district. You have things, of course, there's your Bernie Madoff, who ran a Ponzi scheme. And financial fraud is still widespread. I mean, the only reason why we found out about Madoff was because of the 2007, 2008 bear market, that essentially the returns on the investments that he had were so abysmal that he can no longer keep up his facade. Everything just kind of crumbled around him to where he had to come out there and say, yeah, this was a Ponzi scheme. I was paying my current investors with new investors' money, and the few investments that I really had that were legitimate, they went to nothing. Therefore, I couldn't keep this up. And these are risks that people take, again, when you look at the financial district and working with financial professionals. And really, there is no insurance for that. There is no insurance you can purchase to say, hey, if my broker takes advantage of me, do I get everything back? No, you don't. These are risks that we all retain. You can't get that back. If you gave somebody money to invest in something that you cannot see or hold or understand or even view, that's not something you get returned to you. And a lot of these financial fraud schemes, a lot of these happen to what are known as accredited investors. And these are people who have either high net worths because of assets under management, or they have a high income. And according to the SEC and FINRA, if you are an accredited investor, if you make a lot of money or you have a lot of assets, you can invest in unregulated securities, which means that there's no real oversight over what you're investing in. And this is how people get roped into some of these financial schemes. You hear about people saying, oh, I'm working with so-and-so, and they're very exclusive. I'm invested in these really fantastic things that are giving me this great return. It's really complex. I can't explain it to you, but man, it's really cool if you can work with this person. And then they kind of use that exclusivity to say, hey, yeah, working with me is really great. I only work with a select few. And if you're an accredited investor, if there's no federal oversight, there's no one really looking underneath the hood going, what exactly is this? What exactly are you investing in? What exactly is it that you're putting this money in? These people are giving you money. What is it that they get in return that's actual physical in nature? What is that? Is it liquid? Can they sell it and get their money out and then put that money into a bank account? Yes or no? Liquidity. And so really some of the easiest ways of avoiding the fraud, and I know they sound extremely straightforward, but the fact of the matter is people are still subject to this. This is still happening. I always tell people, especially as they were starting out, as I would have my residents leave OHSU, I'd always say, hey, you're going to find somebody, you're going to work with somebody. It's going to be, always look underneath the hood. Always take the time to get to know that person who wants to use your money, because that's what it is. I mean, you're entrusting somebody with your money. You have to sign a check. You have to do an electronic transfer. You have to give people something. And if you're going to do that, you must understand exactly what is going on. I always tell people, always avoid the person who comes to you and says, hey, I have a guaranteed rate of return. I guarantee you will get something out of this. I guarantee you that this will give you 10%. There are no guarantees. There are absolutely none. The only guarantees that are out there might be like a fixed annuity. All right, that has a guaranteed rate of return. Or the whole life insurance that has a guaranteed rate of return. But even then, you're only investing in known entities, something you can buy and sell. Also, never give somebody your login information. This still happens today, where you have people say, oh yeah, I gave them the, my account number, my login for my 401k, my 403b, my this, my that. Well, you essentially gave a person access and control of your money. Believe it or not, you can go online and request checks. It's that, you build up trust in somebody, and then you let down your guard, and then you give somebody more than what they should have. Never give somebody custody of your assets. It's all these things that you would think you would always do before you work with a professional, but when you get that level of comfort, or when you have like multiple people might work with one individual, your guard comes down and you just want to say, oh yeah, this sounds great, let me go do that. So financial fraud is a big one, especially starting out. Next one that happens a lot, of course, is identity theft. Of course, we hear all the stories about identity theft, and how to avoid it, what exactly it is, things you should and shouldn't do. Yet it still happens, of course. I remember distinctly the year 2014. I had probably 3 or 4 instances of identity theft or fraud perpetrated on either a student or a resident in 1 month. It was a crazy year where I was helping people with their credit checks, credit reports, credit freezes, filing their claims with the police department, because these people had fraud perpetrated on them in multiple different ways. One person had their family members steal their identity. And this was something to where they had access to their social security number, they had their date of birth, they had all this identifiable information, and they left it exposed. They left themselves exposed. How many of us have gotten a text on accident? There's the embarrassing ones, and then there's the ones that you kind of get posted like, oh, here's that login information. Yeah, you just sent it to everybody. We had issues where people were using Google Documents to share information. Well, that's not secure. That's not HIPAA compliant. You have people who use social media to tell people everything. It's like all this information that's out there, and you don't really think about that exposure. And yet again, when you talk about risk and risk management, you talk about, okay, how am I exposing myself to possible loss? Well, it's by using all these different methods. And these are things that are going to be part of our lives forever. Probably the biggest cost one was I had a couple. They were entering into their intern year. They had a fake real estate agent. Think about today, in today's society where everything's done by internet. Here is a webinar right now. Client meetings, patient interactions. To where here's a situation that happened. This was 2014. But again, kind of put it into today's, mindset of, oh, it'd be completely normal to work with a person virtually versus in person. But here they were working with a person virtually. They did the credit check. They did the virtual tour of the apartments. They got keys in the mail. They sent their payment via electronic transfer. Showed up on move-in day. I think it was about a week before their residency was going to start. Apartment was occupied. That agent did exist, but it was a different person. They actually had their identity stolen. Their money was gone, and they had given this person all of their identifiable information because it was part of a credit check, their credit check, social security, date of birth, everything. And coming back again to that standpoint of, wow, what happened there? And how could I have done things differently? How could we have done things differently? How things move forward from here, knowing that now there's a person out there, a bad actor, as they would call it, with lots of information to then use against them, protecting yourselves. Of course, more examples that I've ran into: cell phones. Patient actually stole a receptionist's purse. You have all these things that would happen, on campus, off campus, at work. that you think about all the different exposures, think about how busy life can be in clinic, on call, driving around, just day-to-day life, the chaos of life, and think to yourself like, okay, what is it that went wrong here? What happened? People leaving thumb drives of patient information at the grocery store. Of course, they shouldn't have had a thumb drive with patient information, but there you go. You think about how efficient can I make my work be? However, those efficiencies do lead me to risk exposures. Now, it comes down to protecting yourself from financial fraud or identity theft. One thing I always tell people to do is something very simple, which is I always tell people have the ability to use a credit card for everything versus your debit card. All expenses, because if you think about it, a credit card is somebody else's money. It's a credit card company's money. Your debit card is your own money. You have more liability of loss when using a debit card than when you use a credit card. And when you think about day-to-day interactions, whenever I buy something online, whenever I do something anywhere, I'm using my credit card. Because I know if that site is hacked. I know if something bad happens with that transaction I just did. If somebody skims my information from a credit card reader, they just got my credit card information. Good job. You got, Chase's, you get to use Chase's money, and they'll lock down that card and they'll go after you to get that money back. But I did not lose anything financially. You did not get access to my bank account. However, if you use your debit card for everything, you're always opening yourself up for potential loss. And of course, they have all the promotions that are always going on. Earn points by using your debit card. We'll give you 10% off on gas if you use your debit card versus a credit card. The fees are less to use a debit card than they are to use a credit card. Retailers like debit cards more than like credit cards because the costs are less. But from a consumer standpoint, what are those protections you can put in place between yourself and somebody else and your own assets? So again, in terms of risk and risk management, those simple things that you can do. Of course, if something does happen, other ways to avoid things are, shred everything. I mean, we have one of those monster shredders. And think about as you're working from home more, if you're bringing things home with you, should somebody break into your home, which of course we hear the statistics, not very likely, we know that, but what if? There's all these statistics that they always talk about. But when something actually occurs, then is it reactionary? It's like, oh my gosh, I should have done this. I should have done that. I mean, that's the whole idea about insurance, right? And we have a slide on this a little bit later. People don't buy insurance because the likelihood of that happening is really small. Okay, but something does happen. Then you sit there and go, oh man, I should have done this. Hindsight's always 20/20. And there's a cost to hindsight. You always have to report everything. I mean, you never wait. I always tell people you check your accounts monthly at the very least. You can run a credit report from annualcreditreport.com. You can run a free one for each of the different credit reporting agencies every 4 months. So you can run 3 free credit reports every year just to check your information, just to make sure everything's there that should be there and there's nothing there that shouldn't be. Because anything under your social security number will pop up on that credit report. Always notify the companies. Freeze bank accounts. I mean, it's all those things that you can do that, yes, are reactionary, but again, it's limiting the probability of loss. And yeah, it's annoying to do. It takes hours. Believe me, it takes hours. However, that's a lot less time spent doing that than would it be trying to recreate everything and trying to get your life back. So you can, of course, report to your various credit agencies, TransUnion, Equifax, Experian. You can freeze, which can cost you money. So a freeze actually costs money. Fraud alert, no. One thing I like about, again, when we use the credit card, you have those automatic alerts set up on your phone. something happens, is this you? Yes or no? Of course, it's interesting to me what they alert me about and what they don't alert me about. You know, when I travel back east, I buy something at the grocery store, they don't care. But if I buy gas for my rental, all of a sudden I get an alert. But again, all those different extra protections. So, I mean, in terms of things that we're always exposed to, that white collar crime, that financial fraud aspect of life, it doesn't go away over time. In some cases, you think about it, as your life progresses, as your careers progress, as you start adding to your assets, as you start adding to your net worth, and as you start, expanding on what it is that you do financially, your exposures actually grow over time. And then as you enter into retirement, your exposures grow again because, as you get older, do you have the ability to keep up with everything? Do you have to have safeguards later on? So it's that this area of risk that, yeah, you can get identity theft risk, I think, from State Farm and some other insurance agents, but you also have to keep in mind that these are things that really the only thing a consumer can do to minimize this risk of loss from these various events is, again, be very vigilant about it. You cannot really transfer this risk to another institution outside of what? Using your credit card? Yeah, that's one transfer. You're still not transferring very much else. So then we talk about transfer and retention. So insurance and, you know, how is it that actually helps us financially? So as we're saying with risk, you can either retain the risk or you can transfer the risk. So if you retain the risk, that means that you are foregoing the coverage. Like when people decide not to buy life insurance, not to buy disability insurance, not to buy renter's insurance, you have to buy auto and homeowners insurance. You have to buy those, but you don't have to buy the premium package with all the bells and whistles. So how much risk, how much financial risk are you willing to retain? Versus how much risk are you willing to transfer to the insurance company? So these are your very basic of the basic. I mean, this is what's out there. Of course, there's others. You have business disruption insurance, key man insurance. There's insurance for just about everything in terms to like a type of loss. And each type of insurance goes into greater depth and detail. So again, going back to the value of premiums. If you never experience a loss, then that money you just spent on premiums, in all intents and purposes, was a waste. You put money towards something that gave you no return, and you got to sit there and nothing bad happened, so why did you buy it? And of course, the argument for the insurance is you get this in case something bad happens, therefore you have the insurance and now you're protected. And if you want to hear a lot of really heated debates about finance, get a room full of financial planners and start having them argue about insurance. And the debates go on and on and on. As far as everyone is concerned, they're right. I mean, there is no debate in a person's mind. I've had investment managers say that life insurance is the worst thing ever devised. You should just take that money, invest it into the market. Of course, the counter argument to that is, well, yeah, my premium for my life insurance is $500 a year for $1 million of coverage. And how great of a return do you have to get $1 million? Well, you start getting that back and forth. Just like how much insurance should you get, or should you have it at all? And if you say, yeah, I should have it, then of course that question of, okay, well, how much do I really need? And being that all insurance is a commissionable product, which means that the person who sells it earns their income from the sale, the proceeds of the commissions. So if something cost, if somebody's premiums were $1,000 a year, typically the commissions earned from that product, those life insurance or disability, is 100 to 80% of first year's premiums. So if your first year's premiums are $5,000, the agent who sold that policy to you just earned a $5,000 commission. Now, they might not get anything in the future, but that's your commission right now. However, all insurance is sold commission-based. Therefore, if you're going to buy insurance, somebody's earning a commission. Now it's not so much, okay, do you buy it or not? Is as you're shopping around, is who is it that you want to get the commission? Because somebody will. It's also something to keep in mind as you're being shown different products. When you're looking at the cost of the premiums, is the benefit worth the cost of premiums, or is it just a product being sold because there's a sale involved? So you have the basics. The basics really are, I mean, when it comes down to risk, you have risk pooling, which is you have a large number of people. So some insurance carriers will only work with large groups of people, especially if they're looking at group insurance at like a hospital, or actually when we're shopping health insurance at OHSU. We had a plan where we included students from a neighboring university to create a bigger pool to reduce the cost of the insurance for our students. So if we just use our students at the university, the cost was going to be higher. So by including the students from a nearby university, of course, with their support, and they loved it also because it brought down their overall premiums as well, because it was a bigger pool. Then you have the policy. Of course, that policy is the contract. That's what you sign. Life insurance, you have your life insurance policy. Premium is what you pay. Then the liability is the liability, of course, is what you might owe somebody. Like, what would you be, oh gosh, losing my words right now. As it says here, coverage to protect others from damage that you cause them. So that is your liability. So what is that? What harm did you create? Now, one thing to note right now is with everything that's going on and what I'm seeing happen to some of the people that I work with. So when you're looking at an insurance policy, you never think about pandemics or civil unrest, depending on your area that you live in. You're not thinking, oh, this won't affect me here. And so you have businesses, you have things called business disruption insurance. So if something happens that disrupts your business, such as to say that there's a water main break at your clinic is now unsanitary until you have everything taken out of it. So your business was disrupted. Okay, so you get business disruption insurance to cover the cost of your payroll. Do you have to change locations? I mean, it'll cover various different things, but it will only kick in for certain events. A lot of these places, like the clinics that I had clients at, when they were furloughed because their clinics were shut down because of the pandemic, of course, the first thing their business manager would do, or their CFO would do, or the owner of the practice would do is contact their business disruption insurance agent and say, hey, can I file a claim on this? Yes or no? But then the majority of people, pandemics were not covered because we haven't had a pandemic in over 100 years. So why have it? Why have it on the policy? Civil unrest. These riots that you see going on. I mean, I'm in Washington State, right across the river from Portland, Oregon, like literally a 20-minute drive. And we have, people's cars being torched and buildings being vandalized. All right, so how many of these policies are covering that? And then you look at what's happening now within the life insurance industry and disability insurance industry and how they're making changes based on, okay, COVID-19 is an unknown. There's not enough data for our actuaries to create a policy cost. Therefore, should we exclude or increase the policy premiums for people who might have been exposed to? Like, will it be an exemption for future insurance? So you take a look at what's going on right now, and you throw kind of risk onto it. Here's all these things that we never thought would really happen. I mean, we know riots have happened, but again, we look at it, the pandemic. And if you're looking at, okay, well, hey, I'm accepting an offer at a clinic. All right, well, what happened to that clinic that you might be going to? Or what happened to your own work? How did they respond to this? Or if you're going into your own practice, I mean, what are things that you can do that can protect you in case there is a loss? So it kind of kicks into auto insurance. So here's one that's very common type of insurance that isn't very well explained. Excuse me. So with an auto policy, you have your liability for bodily injury, you have liability for the accident, you have the liability for the property damage. And so when you look at a car, when I hear people say, okay, well, I have an old car, I don't need to have a lot of insurance for this vehicle. All right, maybe, maybe not. We're looking at it in terms of calculating possible losses. How much of it are you going to accept, and how much of that risk are you willing to avoid? So when people say, hey, I don't care if my car gets totaled, I just care about somebody else's car. All right. So how much premium are you willing to pay to mitigate that loss? So you have to have your general liability, you have to have your uninsured motorist, but then you go down to other types of coverage. And then people always want to know, why should I have this other types of coverage? Well, think about it this way. So you have that breakdown. Usually when you see a auto policy, you have that breakdown, 25, 50, 20, which reads as the first number 25 stands for the $25,000 of coverage you have per person for bodily injury. The 50 is per accident. The 20 is for the coverage for the property that you damaged. So if you get into an accident and you're at fault and you injure 3 people in that vehicle, each of them with $25,000 in medical bills, and if that car was worth more than $20,000, well, now you have exposure because you weren't fully covered. And this is something I look at, especially when I deal with people who are in the medical profession, saying that, it doesn't really matter what you drive. It doesn't really matter if it's a brand new car or if it's something you've had since high school. What matters is your possibility of loss should something happen. What matters is making sure that if you are in an accident, that you have protected yourself from your future to the fullest extent that you can. And people don't understand that as a change, as you drive through different states, as you move around, your protections change based on what that state might have as their required protections. And so when you're looking at things such as auto, it's very easy to be underinsured without even knowing about it. Also, you have to look at it in terms of property replacement versus personal liability. So you have your policy that you pay those premiums, and part of that policy, it will replace the property that you had damaged up to a limit. The liability is coming down to the legal costs associated with that accident. So you might have been covered for those medical bills, you might have been covered for the loss of that property, but were you covered in case they want to come back and sue you? I lost income because I was in this accident that you caused. I wanted to sue you for future income. And so this kind of leads me into renter's insurance and what had happened to a medical student. Just matched into surgery. Somebody had broken their toe on their property, on their rental property. They're having a post-match party. This person broke their toe. They were suing the newly matched student for their future income because of pain and suffering associated with the broken toe. This person had renter's insurance, which covered $100,000 of personal liability, which they were hoping that would be enough to settle the claim. I've had people not have renter's insurance as students, as residents, as attendings, because they think to themselves, okay, well, this isn't my property, I have nothing to worry about. Again, risk retention, risk transfer. If you're looking at your career and what you have created for yourself over time, how much of that risk are you willing to retain? And how much of that risk would you rather somebody else take on? So with renter's insurance, it might not be your property that you're living in, but it's your property that's in there, and you still have liability. I mean, we have liability in life. Same thing with homeowners. Homeowners has liability as well, for the family, but it's finite. It has a limit to it. And it will cover, of course, your dwelling. You have to get an, actually, if you have a boat, your boat insurance is a rider in some cases under your homeowner's insurance. And my thing about boats really quick is, with all due respect, don't own a boat, but it's great to have a friend that does. Boats just get expensive. I won't bore you with stories about boats, but it's one of those things that people don't think about as they have the coverage. Here's that ski-doo, here's that great thing that I have. Oh my gosh, I'm covered in case of a loss. So you are able to purchase additional insurance. One thing I always tell people to get is something called umbrella insurance. So umbrella insurance is additional liability insurance you can get on top of your auto, home, or renter's insurance. It gives you additional liability coverage on top of everything else. It starts at $1 million and goes up from there. You just contact your State Farm, your Farmers, your Geico, whoever you might have, Progressive, whoever your carrier is, and just say, hey, I would like to look at umbrella insurance. Premiums for 1 year of $1 million of coverage range between $200 and $300 a year. Yeah, you can keep going up. I believe State Farm, they allow you to go up to like $8 million before you have to go back to their home office to have a actually look at your situation. Like, do we want to give you more insurance than this? But when you hear about catastrophic accidents, especially you think about celebrities and how whenever something happens to a celebrity, it always makes the news, a car wreck or whatever. That's what the umbrella insurance would cover. So if you had somebody, like for instance, if that person who broke the toe and sued the student, if they had an umbrella insurance policy, ended up that their claim was actually found justifiable in court, it would be the umbrella insurance policy that would step up and say, okay, we'll pay that claim. And my thing about umbrella insurance is that what you will pay out over your lifetime in premiums will be less than your first bill you'll ever receive because of liability. I have other stories of people who have had individuals trip over their dog leash. They had their dog on a leash, person tripped over, broke their ankle, claim. These things that just happen in life, that something just as simple as making a phone call and saying, hey, I want to get this added onto my policy, could have helped save you, hours of headache and loss and thousands of dollars in loss. So it's something to always look at in terms of liability coverage. So you want to segue into life and disability. Very highly debated topics and very nuanced based on where you are in your life and your career. So life insurance. It is probably something we're all very familiar with. We've heard about it. No, you pass away prematurely. So we all die, it's just a matter of when. Should you die during the coverage period, there is a check that the life insurance company will issue to your family based on the face value of the policy. Base value. So life insurance falls into two very broad categories. Term, considered pure insurance. It goes for a finite number of years, 10, 20, 30. Some variations in between, but after 10 years, 20 years, or 30 years of paying premiums, if a claim is never made, you no longer have a policy, it has lapsed. That's also the cheapest and is considered pure insurance because that's all you are getting is just the insurance. Permanent, also called whole life, universal life, variable universal life, a lot of different things. But what that is as long as you're making the premium payments, that policy will be in force. It goes on for an infinite number of years until date of death. Or I believe it's 115 for a whole life policy where it will then kick out your premiums that you put in, it'll kick out its value. And this is where you get people going, okay, well, as my assets grow, responsible obligation. I'm sorry, Helen, I just saw that question right now. So the responsible and obligation. Are you talking about the responsible party and the obligation to pay? So I'm sorry, I took that one out of context. You probably wrote that as I was saying something, so I apologize. I didn't get the context of the question, so that's my fault. So going back to the idea of the two primary types of life insurance, you have your term, you have your whole life. So the idea here, of course, is it's protecting you from that future loss should you die. And we have something like whole life. They're saying, well, hey, if anything happens to your health, you don't have to worry about not being, eligible for coverage. You'll always be covered. Versus term insurance, will say, hey, if that might be really cheap, but it goes for a finite number of years. The biggest thing I always tell people is that insurance is not an investment, period. It's not what you use to supplement retirement. It's not what you use to save for college. It's nothing like that. It's a tool. Yeah, it's a tool. But it's not there to meet a future financial need that would stem from savings, that would replace savings. Missing A. All right. Thank you, Helen. I got it. She was trying to help me find a word. Thank you. Let's move to that first slide. So when considering student loans, this is something that is often miscalculated by a lot of insurance agents. So I would have students come to my office and they'll say, okay, well, here's insurance coverage that I got as I'm leaving because I'm young and I don't want it to be too expensive as I get older. And I'll look at them and there'll be the student, the future physician, and they would have, $300,000 of loans, and, they would have, were sold $1 million life insurance policy. I sit there kind of scratch my head. I'm like, okay, I didn't realize it was going to be that much. That's kind of a lot of insurance. Turn to their spouse and say, okay, how much insurance is your spouse getting? They'll say, well, zero. My spouse is not the physician. My spouse does not have that future income loss. I mean, there's no insurable interest. That's what they told me. And my response to them would be this: well, hey, should you pass away, yes, you have $1 million life insurance policy, but your $300,000 of loans, it disappears. However, if your spouse passes away, you still have your debt. And who's to say if you're going to stop working? And what happens if you have kids? And everyone in finance has their little niche, and my niche has always been in the student loan category of things. And as I review people's situations, I always look at, what is the coverage for the spouse, for the non-borrowing spouse? How are they mitigating that risk? What steps have they taken to make sure that if something happens, everyone's okay? And so when looking at loans, being that your spouse doesn't take it over, it's not somebody else's debt, it's just that of your own. Always making sure that if you're looking at coverage for yourself, and if you have loans, make sure your spouse has coverage also. Because it's one of those things that it's a cost that you don't think about. And life insurance is not one of those fun topics. We know that. It deals with a very emotional topic, life. However, as you pick apart all of the pieces, you have to take a look at, okay, what is it that our exposures are should something happen to either one of us? Other one that's hotly highly debated is disability coverage. I think everyone has been exposed to disability in some form or the other. You have your short-term disability, you have your long-term disability. Short-term disability is provided by your employer. It covers things such as time away for maternity leave. I'd always tell my students, getting a highly personal topic. If you're looking at starting a family, make sure you have your short-term disability. That's what helps pay maternity claims. That's what helps keep your income coming in as you're taking leave. Then you have long-term disability, which, you have disability that's either you can buy on your own or is offered as a group. Okay, so, and each has their own pros and cons. You have your group insurance, which is, typically it's offered by your employer. It's usually extremely cheap because, again, you look at that pool of lives. So if an insurance company wants to offer a group disability insurance policy to, 700 people, your cost for that policy might be, $15 a month, $7 a month. It could be really cheap. Or your employer could be paying that for you. Some of that might be part of like a contract as you're signing work. Like, what are some of your benefits? Oh, we pay for your disability insurance. Oh, great. I don't need to buy this thing over here. However, if your employer pays for the disability policy, that means the benefits are fully taxable. So if you had a policy that was supposed to pay you $10,000 a month, but your employer paid for it, that $10,000 a month, $120,000 a year is now taxable income. But your employer paid for it. So that wasn't money you had to spend. Versus you can get your own policy. And if you got benefits out of it, it'll be tax-free. But those policies can be really expensive. I mean, I've heard things such as like $5,000 a year for premiums. They're all over the board, but they're incredibly expensive. But they're also that thing that protects your income and your future ability to earn an income. As you look at provisions of a disability policy, it's always talking about, White Coat Investor is a great resource for like reading up on like disability. People have asked me in previous talks if I've ever read like White Coat Investor, if I like it. I'm like, honestly, I love what they write on disability and on life insurance in general. It's some really good stuff. And of course, you want to read the debates through the comments because there are a whole bunch of people debating the pros and cons on each side from insurance. And as when you look at anything, you always want to hear the positives and the negatives. Like, tell me everything. I don't want to just hear the song and dance of the person who's selling it to me. I want to hear all the pros and cons of everything that's about it. And the big ones that I always tell people to look for, especially looking at disability, it's like non-cancelable. They can't cancel it on you. As long as you're paying your premiums, they can't say, hey, you can't get this anymore. Guaranteed renewable, they can't change any of the riders. In fact, if it's non-cancelable, guaranteed renewable, it's locked. It's not going anywhere. And always making sure it has that own occupation definition to it, which means that if you cannot work in your own occupation, it will pay out a claim. However, just because you can't work in your own occupation doesn't mean that you can't work and do something else and subsidize your income there. So that disability insurance, again, you look at it and say, okay, well, I myself personally, professionally have no stories whatsoever, no examples to share of somebody who's taken a disability claim. None. I can't look at somebody and say, yeah, well, that's kind of a good thing to get. I know it's going to work. I know it's going to be one of those things that you're going to wish you had if something does happen. However, I can't look at somebody and say, yeah, sure, go out and get it. However, of course, you talk to somebody else or you talk amongst yourselves or other peers or professionals you might know, you say, oh yeah, I hear lots of stories about things that have happened. So again, you look at it from risk retention, risk transfer. All right, so if you are out there and something happens and you lose the ability to earn an income, are you set up in such a way financially to where, okay, that's fine, maybe go into retirement. That's why, people will talk about, all right, well, disability, they usually don't cover people over age, I believe it is 65. But if you're, 55, going into retirement, you don't need a policy for another 10 years. Well, maybe you needed a policy for the first 20 years, but after that, do you really need it? Again, same thing with life insurance. Like, at what point do you feel like you're self-insured? Again, get into that idea of, analyzing and saying, all right, well, what are the exposures? Why should I have something? Why should I not have something? And as I'll talk to people as they're transitioning out away from either residency or from medical school, I'll say, okay, well, let's look at everything you might be exposed to. Not trying to take all your money. I'm not trying to tell you where to spend it, but let's look at what your possible costs are. What are you comfortable with? What are you not comfortable with? And we talk about home inventory. Now, this one, to an extent. So with like a renter's policy or a homeowner's policy, you always have replacement value or replacement cost. And replacement cost is better than replacement value. And here's why. Value is subjective, and an insurance company will place a value on different things. So if your TV went up in smoke, that might have been a $600 flat screen TV, but in their mind, that TV you've had for 5 years, we'll give you $50. You can go on Craigslist right now and buy a flat screen TV for $50. Versus value, hey, that was worth $600. It's going to cost me $600 to go get that. Give me that money. Now, some insurance companies will give you like percentage of whatever your home is worth, whatever your so if your home is just simple math, if your home is insured for $100,000, they'll give you 80% of that to replace everything in the home. So that's why some people take inventories. And then there are things where you have exclusions on, like they will only cover, I believe, up to $250,000, $2,500 of collectibles. So that baseball card collection you might have, you're only gonna get $2,500 for. Cash up to certain limits. I believe it's like $1,000. That's why they tell you don't put cash in a safe. So when they say inventory, there's a reason why, because there are limits on every type of policy for how much they will replace before you have to go back and say, okay, well, maybe I need to get an extra rider. And then, of course, as life changes, you make adjustments, either buy more or get less of the insurance. You're always looking at it from a standpoint of, all right, as this changes, what has changed is, hey, single, no kids. You get married, you have kids grew up, they move out. At what point, or how do you ladder different insurances? How do you ladder different risks as coverage changes? I mean, our eldest daughter just turned 14. All right, wonderful. She's going to be driving in 2 years, which is kind of surreal. Great. So I'm going to increase the coverage. Life has changed. I didn't need it beforehand, but now there's going to be another driver in 2 years. So you increase coverage. As she moves out and goes on her own, then you reduce coverage. So again, it's always taking a look at something. It's not just one number set in stone forever. It's fluid. That's something to always keep in mind, is that insurance is fluid. Risk is fluid. Of course, there's the ones that we talked about earlier. They will always have risk exposure to, and others that will come and go over time. So that's the end. We have 2 more workshops left, credit and debt, and then also goals and tools. So different ways to create a financial plan, and also, how credit and debt, we'll even talk about student loans a little bit during that conversation as well. So any questions at all? Oh, thanks for the kudos. Let me see if I can move this down over here so I'm not staring off into space. There we are. So if there's nothing else right now, then thank you for your evening. This will be recorded and will be shared later. Feel free to reach out if anything comes up, and thank you so much for being with us tonight. Take care, be safe, stay healthy.